And in fact, this is really kind of the primary concern for markets everywhere at the moment. What's your hedging strategy here?
Look, the hedging strategy here is, first of all, we look at the inflation two ways. So we think the inflation at the moment is going to be transitory, it's going to be short term, and we don't think it's going to be structural for the time being. Now, so what we're looking at is investing in sectors and companies that has leadership, that has a pricing power to be able to pass on the increased costs, particularly at this point that we have, supply chain disruptions and the like. We certainly need businesses that are able to pass that on to consumers, and then in the current environment, we do think there's enough demand for businesses to do so. So absolutely focus on business that can pass on price increase at this point.
So, how much are you looking at exposure via energy and commodities?
Yeah, so in terms of energy and commodities, that's a natural sector that investors normally gravitate towards. Energy certainly looks well underpinned by the demand and supply side shortage for the time being as we head into winter for Europe and China. And the energy equity has performed very, very well, and we think will continue to do well for the next quarter or so. In terms of the broader base commodity, we're more pragmatic about those commodities because there is, a lot more. China growth is going to slow somewhat heading into year end, and that will release some of the pressure on the likes of the bulks and iron ore and things. So for the broader commodity, we do think it's perhaps looks where it is at the moment, but that is a basket that we do need to have exposure to as part of the portfolio.
So are you saying that when it comes to those price pressures that we're seeing right now, that the energy crisis might resolve first before those supply chain disruptions? And does that affect how you position your portfolio?
Yeah, that's an interesting question. Which one comes first? It certainly feels, as we head into winter, the energy crisis will maintain the way it is. We don't think both will be resolved anytime soon. Certainly not when the global mobility yet to pick up significantly. Next 3 to 6 months, we will see more of those shortages, energy and supply chain disruption. But post 6 months, we should be able to see improved, a debottleneck supply chain side, as well as relief in terms of demand side in terms of the energy prices. So in 6 months we should see things getting better, but that's we do hope it does.
Jun Bei, what's happening with these Chinese stocks, whether it's the Hang Seng Tech Index in Hong Kong becoming the best performer worldwide since October, since the beginning of this month, or the Nasdaq Golden Dragon Index? Why aren't investors more concerned about the regulatory crackdown?
That's incredible, isn't it? Investors are concerned with the crackdown, but this is the nature of the share market. Share market reflects the sentiment of what investors expect to see in 12-month time. Now, when share price was sold off significantly in August, all of these tech companies, in a way, it was oversold. It was pricing in way too much uncertainty, and this is at the same time when Nasdaq was hitting all-time high. So relatively, it presents a significant amount of value. Certainly to deep value investors now can find, incredible buying opportunity in those businesses. So you're right, underlying fundamental hasn't changed, but it got too cheap. Now sort of revert back to, to a more normalized level, still pricing in some uncertainty.